Okay, so anyways, hopefully you can hear this and see this okay. I'm going to talk about the 200-day simple moving average of the S&P 500 and why this is better than just randomly buying and holding and you know, timing doesn't matter and all of that you've heard. Basically, what I'm saying is that you can pick better times to enter and exit the market. So I've chosen a specific time frame here, April 97, end of April to today, because this is when I started working and I had some money to invest. I actually didn't start investing until a little bit after that. Okay, so um, this up here, MABS 200 is moving average with breakout signals. Those are the red green arrows tell you 200-day moving average. And then as I move the mouse around, it'll tell me, you know, if you look at the D, the date, the O is the open, H is the high, L is the low, C is the close, just so you know what's going on here. And then we're looking at right now, today, June 1st. And to make sense of this chart, so the left side of the line here is the open, the right side is the close price, and then this vertical portion represents the range for the day. And you can see it again, open, range, close. And you can see close the day below the 200-day simple moving average. So anyway, zooming back out. So again, so let's go back to the beginning. This is a 97. You can look at the axes at the bottom. You can see the market was on an uptrend. And let's say you got out here when it crossed below. Okay, saved yourself some downside, and you got back in. And notice you had quite an uptrend here. All right, and then get out, get back in, an uptrend, and so on. So we'll keep going to the right. Okay, so now here we're at the year 2000. This is 9/25/2000, and came up here. You can see here's where it crossed below, and look out below. Look how far the market's come down. Here was you could get kind of whipsawed here. Same thing here, but look at this. So you were up here at 1450, and down here you're at 900 for the S&P. And I think everyone remembers the dot-com crash. Let's keep going to the right. Now here at this point, this was around 4/17/2003. Let's see if I can zoom in here. Here's where it crossed back over. Let's zoom back out here. Let's make a note of this date. 4/17/2003. And so here we have an uptrend. So here, 880 or so. Scrolling to the right. And then if you decide to get out at this point, is what, 7/21/2004, you were at, you can also see the X and the Y value, 1,000. The Y value is where the cursor is. And so here you can kind of, you know, here's some downside. You can get kind of whipsawed, but again here, now when it crossed over, look at where that's at. Let's go further to the right. Let's see here. Back down, back up, back down. Oh, excuse the noise outside if you hear it. It's people screaming outside in another house. Okay, so we're at 06. Okay, here, 07 is 1400. Got out, get back in, got out, not much of a gain. Okay, here, you get out and you get saved quite a bit. This is in 08. Let's see here. Let's see if we can scroll, not lose our place here. Okay, but this saved you, let's see, where were we? 08, this huge downturn. If you were just out of the market, here's where it crossed above again, but then you would get back out, you'd have a little bit of a loss, and cross back up. And if you waited for this, you know, to stay above it for a few days and then recognize this uptrend, this is what, 720, around 709, and then it gets huge gain and came back down. These circles are from me having circled them before. These are other crossover points. And Thinkorswim saves these all for you. Here's a big, big uptrend. What was this? 9/13, 9/10, 2010. Okay, and then come back down. and then here was 12/28, 2011, where it crossed above. And these horizontal lines I've drawn in to draw levels of support for, if you know support and resistance. And then here's where we're at again. So you can see, generally speaking, it seems to work pretty well. If you get out when the market crosses below, and then you get back in when it crosses above, and it stays above for a while, then, and get back out, you're, to me, better off than just, riding it all out, because, in some cases, would you really would you have the fortitude to sit this out? Let's say you bought up here in 2000 at 1500, and you're watching your, when was this? 9/1, September 2000. Would you have the fortitude to watch your stuff get cut in half? Just going down, 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 and getting cut in half. At this point, if you had watched this, you would have saved yourself and it's been in cash. And then you could redeploy your assets down here. You can see this is not good for finding the bottom, market bottom, as I mentioned. So anyways, so that's the end of my first attempt at this recording. And I'm going to go over some of the other studies and stuff you can do in here in Thinkorswim.